Welcome to this explainer. Look, we're going to take the totally intimidating world of financial charts and translate it into a clear, visual story that you can actually read. If you've ever stared at a trading screen and just felt completely overwhelmed by that chaotic sea of flashing red and green bars, well, you're in the right place. We're going to break the whole thing down so you can see exactly what the market is desperately trying to tell you.
Let's jump right into a really simple but honestly incredibly powerful idea. What if financial charts weren't just complex math puzzles? What if they were actually visual records of human emotion? Because at their absolute core, every single little movement on a trading chart is just a tug-of-war, a literal battle between buyers and sellers. Someone bought, someone sold. And those decisions, they were driven entirely by human nature.
Basically, these charts tell stories. They reveal fear, greed, confidence, total uncertainty, and overall market psychology. So remember, we aren't here learning math today. We're learning to read the human emotions that drive prices up and down. And honestly, once you wrap your head around that, the chaos suddenly starts to look like a perfectly organized narrative.
All right, so here's our roadmap for this explainer. We're going to cover the market's secret language, the anatomy of a candle, the psychology of price, how to read candlestick patterns, support and resistance, and finally, how to build a winning strategy. We're taking you all the way from the basic ABCs of candlesticks right through to a concrete, risk-managed system. Let's get into it.
Section 1. The Market's Secret Language. Discovering the Battlefield of Bulls and Bears. So let's look at how this whole concept of charting kicked off over 200 years ago with a Japanese rice trader named Munehisa Homa. Now, obviously, he didn't have multi-monitor setups or digital tickers, but he had something way more valuable, a deep understanding of human nature.
Homa figured out pretty quickly that prices aren't just some sterile calculation of supply and demand. They're driven by people, meaning if you can read the emotion of the traders, you can read the market itself. Human psychology just doesn't change. Whether you're looking at modern crypto or traditional stock markets today, they are driven by the exact same fear and greed as those 18th century Japanese rice markets. Crazy, right?
Moving on to Section 2. Anatomy of a candle. Learning the alphabet of the market. Because, before we can read full sentences, we really need to master this alphabet.
So every single candlestick you see summarizes 4 vital pieces of information, commonly known as OHLC. That's open, high, low, and close. And it doesn't matter if you're looking at a super fast-paced 1-minute chart or zooming way out to a daily chart. Every single candle gives you these 4 exact data points. They show you precisely what went down in that specific time frame. And here is where the battle happens. You've got the bulls attacking upwards and the bears striking downwards. When the closing price ends up higher than the opening price, you get a bullish candle, usually colored green. That means the buyers won that round. But when the closing price is lower than the open, you get a bearish, usually red candle. The sellers dominated. It really is that straightforward.
Now, check out those thin lines poking out above and below the main body. Those are called the wicks, or sometimes shadows. If the thick body tells you who ultimately won the hour, those wicks tell you all about the failed attacks and the wild plot twists that happened during the fight. A really long wick? That just means one side tried aggressively to push the price, but they were ultimately totally rejected by the other side.
All right, Section 3, the psychology of price, fear, greed, and the human element. We really need to unpack the 2 massive emotional forces that are constantly driving these red and green candles.
And those 2 forces, as you might have guessed, are greed and fear. We see traders fall into these 2 exact traps all the time, either buying impulsively out of pure FOMO, the fear of missing out, which pushes prices up to totally irrational highs, or, on the flip side, selling emotionally in a blind panic, causing prices to totally tank. So when you see a massive green candle, you aren't just looking at a price hike, you are literally seeing human greed manifested visually.
You see, the market moves in these repeating emotional cycles. We shift from quiet, calm accumulation right up into the absolute greed of a euphoric uptrend before, almost predictably, crashing back down into fear and panic during a decline. Honestly, understanding this cycle is exactly why keeping your cool and maintaining your discipline is so much more important than just raw intelligence.
Which brings us to Section 4, reading candlestick patterns. Combining words into sentences. Now that we've got the alphabet down and we understand the raw emotions driving things, let's put it all together to spot the patterns that signal a major shift in market control.
First up, we've got our bullish reversal patterns. Think of these as your flashing warning signals that the sellers are getting exhausted and the buyers are aggressively stepping back in to push the price up.
Take the hammer, for instance. Tiny body, super long lower wick. That wick tells a pretty dramatic story. Sellers tried hard to crash the price, but buyers absolutely rejected the drop and pushed it back up. Or look at the bullish engulfing, where a massive green candle just entirely swallows the previous red one. Boom, momentum shifted.
Conversely, the bearish patterns are your massive warning signs that buyers are running out of steam and you'd better prepare for a potential drop. Take this shooting star. It's got this long upper wick, showing that buyers tried to soar but slammed right into a firm ceiling of sellers. Or the bearish engulfing, which is basically just a giant red candle that wipes out all of the previous day's buyer optimism in one fell swoop. Now, we've seen what happens when buyers take over and when sellers take over, but wait, what happens when neither side actually wins the battle? Seriously, who wins if the opening and closing prices end up being exactly the same?
Well, the answer to that is a little pattern called the doji. A doji represents a pause. It's this moment of deep, deep uncertainty where the market is basically just catching its breath before the next big move. The open and close are so incredibly close together that the candle basically has no body at all. It is the perfect visual representation of total market indecision.
Moving on to Section 5, Support and Resistance, Understanding Market Context. Because frankly, a candlestick pattern just floating out there in the middle of nowhere, utterly useless, without a map to tell you where you actually are.
It helps to think of these zones as the market's collective memory. Support acts as the floor, and resistance acts as the ceiling. Buyers remember exactly where they made profits at the floor, so when the price drops back down to that level, they naturally want to buy in again. Sellers, meanwhile, remember where they took losses at the ceiling, so they start aggressively selling before it can break through. It's literally human memory creating visible, structural boundaries on a chart.
So the main takeaway here is this. A hammer pattern only becomes a highly reliable buying signal if it bounces perfectly off a known support floor. Make sense? And if you see a bearish shooting star, well, it's way more concerning if it forms right up against a historical resistance ceiling. You have to always combine the pattern with the context.
Let's wrap it up with Section 6, Building a Winning Strategy, Turning Knowledge into Discipline. Because knowing all these patterns is great, sure, but applying them with ironclad discipline, that is how you actually survive the market.
By sticking to these 4 simple steps, you effectively strip the emotion right out of the equation. You wait for the market to tell you a very clear story before you ever risk a dime. You isolate the noise by picking one market, you draw your map of zones, you wait patiently for a specific candlestick signal right at those zones, and, most importantly, you set a strict stop loss so one bad trade doesn't completely wipe you out.
1 to 2%. Honestly, this single number might just be the most important thing you take away today. It represents the absolute maximum amount of your total capital you should ever risk on a single trade. Think about it. If you have $1,000, you're risking 10 to 20 bucks. It sounds tiny, right? But this is exactly how the pros survive brutal losing streaks and manage to stay in the game long term. Protect your capital first, always.
Wow, okay. We've covered a tremendous amount of ground here. The market speaks this beautiful, chaotic language of human emotion every single day, leaving a trail of footprints with every open, high, low, and close. You now have the tools to read those words. But here is the ultimate question for you. The next time the market inevitably panics, are you going to get swept up in all that emotion? Or will you have the discipline to step back and simply read the story the chart is telling you? Thanks so much for joining me on this explainer. Keep learning, stay disciplined, and always protect your capital.